Thanks for having me. Again, my name's Jeffrey Brewer. I am out on the West Coast. I'm going to be talking today about a new swing trading strategy or system and how it helps us locate the best setups. Now, a little bit more about me before we get started. I'm the developer of the system, and as mentioned, I have been a software engineer the majority of my adult career, so I got to work with lots of good Fortune 500 companies out here in the West Coast and cut my teeth on some really great programming systems over the years. And about 10 years ago, I turned my attention and my expertise over to the markets. I had always had an interest in the markets, but putting in my dues and spending all that time becoming a software engineer and a programmer and an analyst and all that really helped out with my my ability to be able to analyze the markets and come up with some new stuff. So I basically, I had a software company out in the West Coast which I shut down about 10 years ago, and I kind of semi-retired, and I spent all my time trading the markets and developing new strategies. Now, we all know that one of the issues that we have with technical analysis is analysis paralysis. You know, a lot of us have great trading libraries, and we've taken all kinds of courses and all kinds of software systems and indicators, and we can end up, you know, with like the best trading library over, you know, after a couple of years, but we never make any money, right? And that's an issue that a lot of folks run into. The market is so vast, and there's so many ways to make money in the market. You know, it's been said that there's probably as many ways to make money in the market as there are traders, because the markets are so dynamic and fluid, and there's so much to them. So one of the issues in any kind of approach to the markets is we don't want to get bogged down in this analysis paralysis. In the beginning, it's really fun, right? You discover all these new indicators and these new setups, but eventually, you know, when the pedal hits the metal and you get down to it, you've got to have a system or a strategy in the market that actually produces, makes money, is profitable consistently. And so a lot of folks, they go through this whole big learning curve, spend lots of money, and in the end they, you know, throw in the towel, and they have nothing to show for it. So one of the issues we deal with in technical analysis is how can we get to the technical analysis that's going to actually help us be profitable in the markets, and then basically forget all the rest. You've probably seen folks, or maybe you've experienced this, where your charts are completely loaded up with indicators and oscillators and strategies and moving averages, and the initial feeling is that more information is better. The more information you got, the better decision you're going to be able to make. And in the end, in reality, what happens is all of these oscillators and indicators and strategies and moving averages, they all work off the same base data. So there is only so much we can actually get from, you know, pure price data, volume, that type of thing. So the effort should be to reduce all the technical analysis down to the minimum that works, right? If, in other words, if something is unnecessary, there's no reason to include it into your methodology. So what I've done is I have created a new mechanical swing trading system. I keep saying new. It's new to the public. This strategy is something I began working on literally about 10 years ago. So let's talk about a lot of the mistakes that folks make in swing trading and trading stocks. We're going to just start off with some basic stuff so that we're all kind of starting on the same page, and then I'll launch into a review of the new strategy. These are common mistakes that traders make. Premature purchases of a stock. How many times have you seen, you know, stocks maybe selling off a little bit, and maybe you've been watching that stock and you want to buy some shares, and maybe you took a flight or something and saw an article about it, so you're getting excited about wanting to buy that stock, and but the stock's kind of selling off a little bit, but eventually you can't control yourself anymore and you buy that stock because you want to get into that stock. Unfortunately, you might be buying a stock that's going into a big sell-off, a big downtrend, or distribution, and so you're going to be the one left holding the bag as those shares drop in price and go against you. So premature purchases of a stock price is a biggie because people feel they're going to miss something. They got to get in quick, right? Because they're afraid, they're going to wake up the next morning and the stock's gone. Another big error is lump sum investing. That's where somebody, gets into the market and they basically just get in all at once. Maybe somebody has come into some sizable capital. Somebody left some money to you in their will, and you've got all this money, and the worst thing you can do is just put it in all at once, like buy one stock one day, because what you're doing is you're basically placing all your bets on one price. Okay, so lump sum investing, the issue with lump sum investing is it could be the best thing ever if, needle in a haystack, you catch a 10-bagger, right? However, once you take that lump sum bet, everything's bet on that one price. Another big mistake that leads many to ruin is averaging down, especially into margin, which I've done. And that's where you have a company that's so great that you got to get all of your available capital somehow into that stock. And as the price goes lower, right, it's even a better value, right? So you keep buying more at a lower price, averaging down. Now, if you averaged down or around a certain zone, but you had a limit and then you had like a stop loss, that's a little different. That's more of like a macro trade that you are kind of splitting up a little bit. But averaging down, where you basically just, damn the torpedoes full speed ahead, and you just keep throwing capital at a stock that keeps going down, is a way to wipe out your entire account. I know because I did that in my second year of trading. Averaged down on a bunch of stocks that I thought couldn't lose. The market crashed. I was heavily in margin. Bank wanted all their money back. When they got all their money back, I had zero in my account. All right? So that was a big, expensive learning mistake. Putting all your eggs in one basket. That's where you basically load up on just one stock, or maybe two. What's happening there is, by the very nature of the stock market and news and the way company fundamentals can kind of change on a dime sometimes, you're putting too much risk in one area. So a little bit of diversification is important. Now, the final big mistake is not using protective stop losses. And, stop losses are something that we could have a debate about it. We could bring in a bunch of gurus and debate all the pros and cons. But in the end, some of the biggest losses and some of the nastiest drawdowns I've seen and I've experienced have just come from not using a stop loss. A great example is, and again, this is all a long time ago because I've learned my lesson on this stuff. I was in a trade for, I believe it was 500 shares, and what could have been, maybe like a $500 stop out within a week turned into a 9-month drawdown that was a $6,000 loss because I let it get away from me. So we don't want to let the genie out of the bottle, because once things run against us, then the issue's even more difficult. It's kind of like jumping out of an airplane without a parachute, and then you look up and you say, hey, what do I do now? Right? So you never want to have exposure in the markets without some kind of protective stop loss. So these are all the standard kind of rookie mistakes that people make that lead to losing money. So the very first thing we want to do is we want to avoid mistakes that lose money, right? Now, the basic concept of swing trading is this. We find a stock that is trending or has momentum, in other words, price is moving, and we want to jump on board that trend somehow. So think of, a freight train going by and it slows down just enough for you to run and jump on board, and then it speeds up again. That's really the whole concept of swing trading. We want to identify a trend. When the price pulls back, we want to enter on that pullback, and then we're hoping that the trend resumes. Now, you might ask, well, what's the big deal? If I'm kind of in this for a while, let's say, and the stock's going to continue up, why do I care so much about this pullback business? Why don't I just jump in and wait, and the stock will go higher? You could do that. If a stock is truly trending and it's going to be higher in 3 weeks down the road, then sure, it might not matter exactly the day you jump in. However, one of the issues, and I just talked about this, we have to use a stop loss. All right, we've got to use a stop loss to prevent catastrophic loss with a trade running against us. Now, the very fact that we have to use a stop loss, that brings us to the whole problem of, well, how close should the stop be? Do we want to use a wide stop? Do we want to use a tight stop? The problem with stops is this. We have the dilemma. If the stop is too close, we're going to get knocked out with higher frequency, and then that just adds up to the same as a big loss. If we put our stops further away in the hopes of, we're going to be able to stay in more trades, then eventually, though, that wide stop does get hit, and it ends up equaling just all the small stops, right? So the dilemma there is, we can't win for losing. So the stop placement is real important, and that's why, other than setups, we've got to focus on where does that stop need to go so that it doesn't get hit. It's there to protect us, but we don't want to get knocked out. So here's the whole thing about the pullbacks. If a stock is going up, surging higher, and it's going to pull back, let's say it pulls back 1% or 2%, or depending on the stock, it could pull back 3 or 4%. It makes sense to wait for the stock to get to an area where it's going to have support, then take the entry, and then we can get our stop further out, right? Then our hope is that price, as quickly as possible, is going to start moving in our favor away from our stop. Okay? So, if we just jumped in up on the price surge and we put our stop in, that stop might get hit as the stock naturally pulls back. Right? And we got to put that stop in there. Now you might say, okay, well, we just use a wider stop. Well, then if that stop gets hit, we have a bigger loss, so we'd have to reduce the number of shares. So what we're doing is we're kind of fine-tuning the entry with timing so that we can actually get by with a tighter stop that has a high probability that it won't get hit, and then we can take a little bit bigger position. So that's the whole reason for the pullback. Stock makes a surge. That is our wake-up call, basically. That tells us that the price is actually in motion, and in other words, we got a live one, and then we're going to look for an area on a pullback. And again, that's so that once we take our entry, price is going in our favor as quickly as possible, and we can get by with a tighter stop. All right, that makes sense. Real basic concept. Now, the goal of swing trading is we want to capture short-term profit in as little as 2 to 5 days after the brief pullback or the period of consolidation. Now, we have variations of how we can play the market. We can play stocks. We can go for more of the micro swing trades of 2 to 3 days, which are a lot of fun. If you can catch a stock at just the right time, you can profit handsomely on these little parabolic moves that stocks make. Or you can get into a stock that maybe takes a little bit longer to get off the launching pad, or you want to take advantage of a little bit longer of a run-up. So you can stay in trades for 2 to 3 weeks or even longer position trades. Now, if you were just to to average out all the trades that you might do, your short-term swing trades and your longer 2 to 3 week trades, you're probably going to get an average of about 5 to 8 days on a typical swing trade. All right. The whole concept, though, is get in, make your percentage, and get out. 3 goals of swing trading. We would like to have more winners than losers, and we want our winners to be bigger than the losers. So we focus on those 2 things and no catastrophic losses. We're going to make money by default. Okay, so here's what that means. Remember, I said our biggest, everything in the market is a dilemma. It's like a double-edged sword. Our biggest threat with swing trading is overnight risk, catastrophic gap down based on a news event. Most of the time it's earnings, okay, bad earnings, or like a pharmaceutical company that their big famous drug that's going to make billions of dollars gets rejected. Those are 2 classic examples of where we see like big overnight, catastrophic gaps. So we want to avoid the catastrophic losses. Now the other thing is this: the danger then is, you don't want to be taking trades like the day before earnings, which a lot of people are attracted to that gambling mentality, but it is just a pure gamble. How a stock's going to respond to their earnings, who knows? So what this means here is, in the end, let's say that you paper trade any system, and you get 100 trades under your belt, and that's always a good benchmark. If you test any kind of system, I usually use 100 trades, like with my day trading systems, to get a feel for, do we have something that works or not? So if you, let's say you took 100 trades, you'd want to have more winners than losers, and if you average everything out, you'd like your winners to be bigger than the losers. What that means is, that's forcing you to do the thing you hear all the time: cut your losers quickly, let your runners, run. Now, one thing about swing trading is this: you cannot make consistent profits in swing trading by reading today's fundamentals and acting on that information. Swing trading is, I should say, almost 100% technical. There's a little bit of news in there, and you can kind of mix in some fundamentals a little bit, but the problem with fundamentals is this. Fundamentals are great for stock selection, which ones, with the actual companies you want to focus on, but fundamentals kind of suck for timing. So the best approach is a combination approach. Maybe you build your watch list, your stable of stocks based on fundamental outlooks, and then you make your trading decisions based on the technical price action. I say you cannot make consistent profits because you could try it for a while and it might work by luck, but over the long run, fundamentals are not going to help you. Now, let's talk a little bit about system design. In trading, if you think about the concept of what a system is, in trading, we've got to take an entry and then we've got to close that entry out, right, to complete the transaction. In the middle there's all kinds of stuff. Where do we place our stop? Where do we pick our targets? Are we going to scale out like in several positions and several exits? How close do we trail the stop? Stuff like that. Position sizing. So one of the issues that I've learned over the years working with the markets and developing strategies and systems is that every little change you make can have far-reaching repercussions. So the best best example is the Rubik's Cube. How you change one thing, it screws a bunch of other stuff up, and that's so true with any kind of system design. You can have the greatest setup in the world, and you make one tweak, and it messes up several of your entries, and that's an issue we have. Just to give you a real quick idea, in system design, let's say that the starting off point is some kind of basic setup, right? How do we get into the market? And so we could, run our back test and whatnot, our forward test, and we could find a bunch of places where the setup failed on us. So then we go, how can I eliminate these failures? What can I do to tweak this, maybe put some filters around the setup so that I avoid these losers. So you make your changes and voila, you avoid those losers. But in the process, you also prevent a couple of the big winners that you got into, see? So it has an adverse effect in another area. So whenever we talk about system design or trading strategy or any kind of methodology, there's going to be the basic approach, and there's going to be different configurations that might work differently, right? So we just have to keep that in mind. Now I'm going to burn through some of these relatively quickly here so we can get to the good stuff. But we all know that, we've heard that the market is range bound, some say 70% of the time, and that we only trend 30% of the time. That's kind of a generalization because when we're dealing with stocks, each stock is going to have its own personality. So you might have one stock, it could be stuck in a range, 98% of the time, never moves, right? And then you have another stock that's one of the popular trading stocks, and it's been on a tear for a year, right? It just keeps going up. So it's trending 95% of the time. So with individual stocks, these kind of numbers are going to change. But the main takeaway is this is not where we make money. This is the part where we make money, the trending action. Okay, because we're getting a movement. I like to think of the trend, and I've done all kinds of trading, and I went through a period where I kind of fancied myself like this master counter trend trader where I could short the market, and day trading too, where I could short against the trend. I can still do that, and I have really finely tuned entries for counter trend trading. However, over the years, it's dawned on me, like you read in all the books, that the trend is what we want to focus on, because the reason why is it has to do with accumulation distribution. If a stock is in a big trend and under lots of accumulation, that price is moving in a certain direction, and a good way to think about it is like an oil tanker that's steaming out to sea in a certain direction. That sucker ain't that easy to turn around, right? If you think about how do you turn an oil tanker around that's moving full speed, it's going to be very slowly, right? So the same thing with a trend. Once a good trend gets going, that has to do with supply and demand rules and all that kind of stuff and the float of a stock. And so we can see these trends continue and continue. And a good way to think about it is if you just casually took a position in a stock and you forgot about, where would that stock most likely be in 2 weeks? So if you're playing the trend, most likely it's going to be going in your favor, right? So what we're looking for is we're looking for stocks that are moving in the momentums to the upside, right? Now the system I'm going to share with you today and talk about is long only. It's basically just long swing trades and accumulation if you want to build positions in a stock. So here's our typical scenario. We look for a stock that surges, maybe makes some new highs, breaks out of some congestion over here. Some of our big key moving averages, maybe they start to slope up, right? Price is above it. And we typically see price surge, price will pull back, and this is due to short-term traders, right? They run the price up, they take short-term profits, run it back down to support, and they do it all over again, right? In the meantime, there's steady accumulation also, buyers and holders, so the float is shrinking. That's driving price up. All right, now I have modeled this swing trading system using pivot days. So let's talk real quick about what a pivot day is. Pivot days are referred to many different ways. You can call them swing highs and swing lows. They used to be called ringed high and ringed lows because in the old days, the technical analysts analysts printed charts out on paper and actually drew circles around with a pencil. So they call them ringed highs, ringed lows. Reversal high, reversal low. The new hippie movement calls them fractal highs and fractal lows. Buying climaxes and selling climaxes. These are not to be confused with day trader floor pivots. That's something different. So what a pivot high is, or a pivot low, just so we're all on the same track, just think about one bar that exceeds the rest. It's an easy way to think about it. Here you can see we've got bars trending lower. One bar pokes down, right? Penetrates, makes the lowest low. So we end up with several lows that are higher to the left, and then we end up with several lows that are higher to the right. It's a pivot low. Pivot high is just the reverse. We get price rising, and then one bar. We can have pivot days with two bars too, where they're the same, but you just basically just glue them together, and you still got a pivot high. But think of like a little antenna sticking up. The high is higher than the previous four and higher than the following three or four, right? That's your pivot high, your pivot low. Now, the thing about pivot highs and pivot lows is they're ubiquitous. They're all over the place. This is one of the things that it dawned on me. Again, this is all like a decade ago, staring at charts. In those days, when people had printers, I used to print charts out and draw lines on them and study. And the interesting thing is you can do this little exercise. You can take any stock chart, print it out, and if you sit back with a pencil and draw circles around the pivot highs and pivot lows, you're going to see that they're all over the place. Right? Now, the neat thing about the pivots is they also tend to be harbingers of price change. So you can see here was one, price went up. We got one here, price temporarily went down. Another little pivot low there. So everywhere we get a pivot, we pretty much get some type of price reversal. All right. Now, I'm not like a big pivot guru. I haven't dedicated my entire life to pivots or anything. But pivots, what's nice about them, let's go back to this chart, is they make a good starting off point for any system to begin your calculations from. Okay? In other words, they're so obvious that once we detect a pivot high or pivot low, we can then project or base formulas off that high or low, right? And that's exactly what I did. That's why this swing trading strategy is relies off these pivots. Now, again, a pivot is any bar that, let's talk about a pivot high because that's one of the ones we're going to be using. We watch for a bar to stick up, a little antenna. Now, one thing about pivots is this. Your official technical analysis pivot is 4 bars before and 4 after. However, we have an issue. We can wait for the 4 bars before, right? But if we wait for 4 bars after, we might miss the action. We might miss a trade, right? So what we do is we look for the 4 lower lows. I got an image here with 3, but 4 lower highs before, and then on our very first bar, we're going to go ahead and assume that that could be a potential pivot high, because we got to get in and take action. If we wait, like I said, if we wait around 4 days, we can miss all the action. Now, the basic components of the swing trading system that I'm going to talk about today is, and again, what I've done, folks, is we want to get away from this analysis paralysis. When you open up a new trading platform with all your charts and all these gizmos, it's real exciting and it's fun to play around with all this stuff. But in the end, does it help you in your analysis, and does it help you in your decision making and making money? What I've done is I've reduced things down to a real straightforward step-by-step process, and it utilizes some real basic stuff. Sometimes the basic stuff is all we need. So what we're going to be doing is we're going to be looking for pivot high and our pivot low bars. we're going to use a good old-fashioned conventional trend line. We're going to take two key moving averages and we're going to watch for a crossover. And then we're going to use a specific formula to to calculate our buy points. Okay, so everything is real basic and real straightforward, and you don't need all kinds of indicators and stuff on your charts. You're going to also learn where do you place your initial stop loss, how do you trail the stop, right, if a stock starts moving in your favor, and then how do we figure out like targets. Okay, we want to answer all these like important questions. Now, the first thing let's talk about is avoiding stocks in a downtrend. You know, half the battle in trading is just knowing when not to trade or not to be in the market, right? If we can just figure that part out, we're going to increase our profitability, you know, like 50%, like right off the bat, just by staying out of stocks doing the wrong thing. So my strategy utilizes two key moving averages. They're not your standard moving averages that everybody uses. You know, what everybody uses, like the 50 EMA and the 200-day and maybe the 30 EMA, that type of thing. They're not your standard moving averages. Years ago, what I did is, again, because I'm my own computer programmer, I can write all kinds of analysis programs. I did exactly that. I wrote some analysis programs that analyzed all kinds of different moving average combinations. Now, the thing about moving averages get a bad rap. You know, you'll hear, oh, moving averages are lagging, they're useless, you know, blah, blah, blah. Moving average crossover systems got popular when the initial, the initial personal computers became prevalent, because then people could start plotting stuff on screens. In the old days, people actually drew moving averages in by hand. So imagine all the work you'd have to do. So the first thing we want to do is we want to know, where is this stock a stock to be avoided? Moving averages are great for lots of different things. They help us with, for one, just a good visual reference point. So something as simple as this. Our light blue here, that's going to be a fast moving average, and the darker blue is a slow moving average. So when we have the price, when we have our fast moving average below our slow, they're both pointing down and price is below, guess what? That is a downtrend. You don't touch a stock like this. Okay, so that's your first rule. Stay out of stocks that are in a downtrend. You're not going to miss anything. That's the biggest fear. You know, if I wait around too long, I'm going to miss it. Yeah, you could get lucky and catch the absolute bottom. It's possible just by pure dumb luck. But more often than not, you're going to be making that first mistake I talked about, premature entries. Right? Now, here's an example where our fast-moving average is sloping up and our slow-moving average is sloping up. Fast-moving average is above, the price is above. So again, great visual reference point. That tells us we've got a stock that's in an uptrend. Now, one of the most important things, one of the most important, valuable technical signals that we can, strive to utilize is the trend shift. When do we know, when can we detect that the big downtrend that's been in place is actually shifting and our price is going to start going up? So see, again, what happens is people who fall in love with their stocks fundamentally, they're looking at things from a value standpoint and they're going, oh, the price just went lower. I'm going to buy some here at a better price, right? Stock attempts to go higher and then takes another winger lower, right? Oh, it's even a better price. I'm going to buy more here. So basically, this is where a lot of our traders lose. They're trying to trade a stock going the wrong direction. Okay, and I've made this same mistake, taking big positions like right here, right? Adding on here, and then finally you capitulate down at the bottom with a big loss. Price turns around. So our most important skill is the trend shift. Now, I already talked about this. when we look at our pivots, what we're going to be doing is we're going to be looking for a 4-1 pivot, is what it's called. 4 lower highs, the pivot bar, the little antenna sticking up, and then 1 bar after that's lower, and we're going to anticipate that that is going to be the pivot, right? You'll see why it's okay that we do the anticipation. Now, in software, what I've done is I've built in this strategy, it utilizes a piece of software that I get you set up with, and it utilizes what I call the pivot high calculator. Now, this pivot high calculator has a kind of an interesting story, which I'll tell you real quick because I got lots of slides here. Okay, so the pivot high calculator has an interesting story. Again, this is all goes back about 10 years ago. I had offices in San Diego, and my offices for my software company, and this was right when I was getting involved in the markets and starting to develop stuff. I was right down the street from the state college, one of the state colleges, and they had an internship program, and I hired 2 interns, a finance major and a math major, and they were in my office for about 6-8 weeks, and I gave them a cubicle to work in, a computer, and I had them working on all kinds of cool stuff, and the best thing that came out of that internship is we developed the formula that goes behind this pivot high calculator. What I wanted to do was I basically said, okay, if we can spot a stock that is potentially beginning a new uptrend, and it has all that momentum working behind it, in other words, the stock's going to start under accumulation for us, what kind of formula can we come up to project areas that the price would pull back to? Now, most people think right away, oh, Fibonacci levels and that kind of thing, or moving averages, and yeah, some of that stuff kind of works. What I did is I developed a purely mathematical formula based on that particular stock's average true range, the price configurations, volume, that kind of thing, and it ended up being a real nifty formula, and I put it into this pivot high calculator. Now, I had this calculator available for a long time for folks, real popular. I still have people coming out of the woodwork saying, hey, is that calculator still available? I really like that thing. What I did is I built a swing trading strategy around this calculator. All right, so that's what we're going to be talking about today. Now, the thing about the strategy is we want it to be real straightforward, easy to follow, systematic, mechanical, that type of thing, right? Because the worst thing in the world is you have an approach that's too complicated, and you just can't really engage with it. There's just too much, and patterns are too rare, they don't pop up enough. So this is a real straightforward strategy. We're looking for a trendline break. We're looking for a moving average crossover, right? Real basic stuff. Pivot high day spotted. I showed you, I got a spelling error. I showed you how we find that 4-1 pivot. And then once we have these 3 criteria in a stock, we're ready to jump over and use the pivot high calculator. That's going to tell us exactly our buy points. And so here's how it kind of works. You're going to learn the 2 key moving averages. All right, these aren't moving averages that I don't think anybody uses these moving averages, but they're the ones that test it out the best for the swing trading cycle. You're going to learn how to plot a trend line correctly. The biggest issue with trend lines is people draw them all incorrectly, or there's many different ways you can draw a trend line based on your rules. I'm going to show you a real easy mechanical approach that's very unique and specific to this strategy that will have you drawing the perfect trend line every time. Once we get those 2 criteria, we're going to look for our pivot high bar, right? And then we just go over to the calculator, put our symbol in, and the calculator goes out and grabs the stock data and automatically does the computation. It's going to give us 2 buy points for the pullback. All right, so here's kind of what the whole thing looks like together. trend line break, moving average crossover, right? We need those two things to occur. And then we're looking for our first potential pivot high, which we can see it here. So on the close of this day right here, you can see I have a vertical line. We've got our potential pivot high, right? 4 lower highs, the pivot, little needle sticking up, and then one day after, and there's the close. Now we go over to the calculator, put this symbol in, it's going to tell us where to buy this stock. Now I'm going to show you a couple different examples of how this plays out. Using, again, here's our pivot high. I think this is the exact example. Yeah. There was our pivot high. Here was our date that we put it in the calculator. The calculator gives us 2 buy points, $3.95, $3.40, right? So we put our orders in, and the great thing about this is you can just put your buy limit orders in, good deal, cancel, and let the orders fill. You don't have to be around at the computer. This isn't where you're having to make sure that today was an inside narrow range day and you've got to wait for the price to go up through another level, and it's none of that. You basically place your limit orders at these buy points and they get filled or they don't get filled. So you can see in this example, the price actually came down the very next day, filled at the first buy point, got really close to the second buy point, but there was no entry. And then the price turned around and went up and made a big run. Okay, so question, why do we have 2 buy points? Well, the reason there's 2 buy points is so that we can hedge our bets. See, when a stock price is in motion, we don't know how that stock's going to, play out. That stock, we could get a move and we could get a very shallow pullback. In this example, we got kind of a shallow pullback, then a big run up, or we could have a real deep pullback. We don't know how that stock's going to behave. So we're hedging our bets and we're putting in 2 entries to basically hedge our bets. If we get a shallow pullback, we'll at least get picked up on 1. And if we get the deeper pullback, we'll get picked up on 2, and then we're dealing with an average share price, right? So when we're figuring out our position size, we always want to break it up, split it in 2. So let's say we were going to buy 100 shares of the stock. We would put an order to buy 50 in at the first buy point and 50 in at the second buy point. If they both get filled, we've got 100 shares right in the middle at the average share price, okay? All right, here's another example. Again, this is like a 1, 2, 3 criteria you follow. There's no ambiguity. You're not hunting for all kinds of conditions and all kinds of setups. You don't have all these complex rules that you have to follow. You're looking for 3 things. Looking for the trend line break. So in this example, you can see the way that the trend line got mechanically drawn was way down here. And so we had our price cross that trend line. And then we finally got our moving average crossover a little later after the trend line break. And here's one thing. It doesn't matter which comes first. If the price breaks the trend line or we get the moving average crossover, it doesn't matter which was first. We just wait for both. Why do we do these both things? I mentioned earlier that moving averages, they get a bad rap. And mainly that's because everybody in the very beginning started tinkering around with moving average crossover systems, which looked beautiful at first, because anytime you get a big swing in the market, any kind of moving averages are going to cross, right? And there's your perfect signal. The problem with moving averages is we can get lots of false crossovers or whipsaw when the markets are range bound. So if you had a completely mechanical system that said, every time these 2 moving averages cross over, buy, you're going to get tripped up a lot. You're going to get pulled into a lot of false wiggles. Having a second confirmation, or let's say like an extra filter, helps us. So by having a trend line break and the moving average crossover, we're getting like a double, like a confirmation there. And the same thing goes for the trend line break. Instead of just a trend line break and then going ahead and jumping and buying the stock, we could have a false trendline break too, right? So, but when we put the two together and we end up with a pivot high above both, this helps us with the probabilities and the statistics for follow-through. Okay, so again, here's our criteria: trendline break, moving average crossover, our very first pivot high. You would go and put your symbol up in the calculator, hit analyze. It grabs the data for free. You get 2 buy points. Here's another example where this was just a shallow pullback. You can see it came down and it literally turned like right at the first buy point there. Right? Never went down and filled you at the second buy point, and then turned and went on its way. Here's an example. Another example. Here was our trend line. Here was our moving average crossover. Here's our price getting across our big trend line, mechanical trend line, and here's our first pivot high. And then we use the calculator. It determines the 2 buy points. And this one, again, this one got filled on both. So then you're dealing with an average share price down here at like 50.50. All right, and then price makes its move. Here's an example. Again, moving average crossover. Then we had the trend line break, pivot high, your potential pivot high. So on this day right here where I got the vertical line, on this close, you're going up to your calculator and putting the symbol in, getting these 2 buy points. On this day here, you're putting limit orders in, good till canceled down here at these points. And you can see this is interesting because on this particular example, it got filled on both the same day. So your average price is in the middle, and then you can see how we took off. Okay. Now, besides short-term swing trading, which is great fun, and it's fun to make profits quickly in a few days, there is the concept of longer-term accumulation. That's where you build a position in a stock. Remember I said the other bad thing to do is lump summing, because you're basically, throwing everything, you're betting everything on one price. A better approach is dollar cost averaging, but averaging up. And most people think averaging up, why would you want to do something, you're going to pay more? Well, averaging down, we know, can get you into big trouble. You're basically, they say throwing good money after bad. What you're doing is you're putting more and more money into a stock that's performing less and less. It doesn't make any sense. When you average up, you're actually putting money into a stock that is performing because the price is going in the right direction. So a great way to profit with stocks besides just short-term swing trading is gradual, little bit longer-term accumulation. This could be a few weeks, this could be a few months, this could be all year if you want to accumulate. I've done several accumulation trades like this that turned out to be my biggest and most profitable trades ever. I did a dollar cost averaging accumulation up on gold back when it was at $400 an ounce, and I accumulated up to about $800 an ounce, and I rode it up to the highs, right? And I accumulated over the course of a year. So that was a good example of what you can do. So again, here's a macro example of, here was our trend line, here was our moving average crossover, here was our trend line break. Remember, we need the 2 of them to confirm each other. And then we got our first pivot high here, and then the calculator, pivot high calculator, determined buy points here. So we went through this whole cycle all over again. There was a pivot up here, and there was more buy points down here, which was higher than the previous entry, so we can take that, so on and so forth. Same thing here. We got some new buy points here from the calculator. That area is higher than our previous purchases, which means we're averaging up, which means price is performing. So if you think about it, and again, if you're still scratching your head going, well, why would you want to pay more for a stock? Why not buy it lower? Well, here's the issue. I talked about the need, how we need to diversify a little bit. So let's say that we had a basket of 10 stocks, and we're following all these mechanical rules on those 10 stocks. think about it. A portion of those stocks, maybe we get a crossover but no trend line break, or maybe we get a trend line break, no crossover. They never engage, right? They never meet our criteria. Maybe a portion of those stocks will give us our first pivot, and they fail, right? But some of the stocks are going to go ahead and actually perform. In the middle, it could get chaotic and volatile and seemingly, undecipherable what's going on. But in the end, it's going to be up in the right-hand corner of the screen here on your chart, right? It's just the way it ends up. If you have a mechanical strategy like this and you only allow yourself to buy at higher points, that means with your basket of 10 stocks, maybe the 2 or 3 that end up on the right-hand corner up here, the big run-ups, they're going to be the ones that pull all the money in, okay, automatically. The other stocks that don't meet the criteria won't get any money. You're starting to see the logic here. So if you're dealing with a stable of stocks and you follow a mechanical averaging up strategy like this, only the performers pull the money in. See how cool that is? Averaging down, all the losers pull all the money in, right? That's why people go bankrupt trying to average down. All right, so that's another way, another concept. Some swing traders just like the short-term swing trading. Some folks want to be longer-term investors, and some folks like me, I like to trade both approaches. I like accumulating, and I also like the short-term. All right, so basically I just talked about everything here. Short-term swing trades of 3 to 5 days. If you want to hold on a little bit longer, remember, as long as you get a position in the market and the price starts moving in your favor, and you can get that position protected with a trailing stop, and you actually get the stop to break even, now you're wide open to how long you want to hold that stock. You're not forced to have to sell it in 3 days. If it performs for a month, you can hang on to it for a month. All right, now the benefits of using my pivot high trading system are you're going to simplify your swing trading approach greatly. You're going to follow a well-defined trading plan. You automatically increase your success rate. I can guarantee you that because you won't be buying any stocks that are going to be in a downtrend, so that's going to eliminate losses and stop-outs right off the bat. It's very easy to implement and easy on your nerves. It's easy to implement because the rules are real basic. You don't need any kind of fancy equipment. Any charting platform, even like the free stock charts, you can find the moving averages you need, and you'll be able to draw the trend lines exactly in the mechanical way you're going to learn. And then another big thing about this is the concept of, I call it pyramiding, where you gradually increase your position sizes. The biggest mistake that new traders make, is they think they have found like the greatest strategy ever, and they rush it into production, right? They read it in a book, they go, oh, this looks great. They see a few examples, and then Monday morning they're dumping their whole account in trying to trade the system. The problem with that is if you get hit, we know that all systems and all strategies, all setups, there is a failure rate, some percentage of a failure rate. You're going to have stop outs, just the way it is. There's a little bit of randomness in the markets based mostly because of news catalysts. So if you start off too big, one of the issues is that you might take some hits and you get gun shy and quit the system. Swing trading systems, if you think about it, it's not a one-time bet. It's not like you win the lottery and you're rich forever. It's a process. You have to follow a process. You're going to be doing lots of transactions. The edge and the profitability come over the series. It's a real important concept to get. So that means that you're not going to make all your money on your first trade. You're not going to make all your money on your second trade. You're going to make money over the series. So the most important thing is to not quit the series right at the beginning because you made a bunch of mistakes and took really big stop outs. So a real important concept is to start extremely small, and as you are using the system and taking the trades and going through the series, if it's performing for you, then you can increase your position sizes, okay, down the road. And this is a real important thing. I teach you this whole strategy and how to follow it. In the beginning, you don't even want to be concerned with how much money you're making. You just want to get the mechanics down, get the motions down, and you're going for the percentages. So forget like the dollar signs and just think percentage. Your goals for profitable trading are knowing when to stay out of a stock. Okay, that can be dangerous and lose you money. Knowing when to look to get in, right? And that's the big trend shift. And knowing at what price to buy that stock. These are like the three key things that we want to do in any kind of strategy, and this system addresses all of these three issues. Now, one real quick thing before I get into some actual screenshots and whatnot is, in trading, I was talking about we win over the series. So you basically want to adopt the attitude that when you're taking trades, you're going to try to trade as close to break even as possible. So you might have a small winner, you might have a small loser, you might have another small winner. You want these to kind of cancel each other out. And again, this is where preventing catastrophic loss is real important, because one catastrophic loss will screw up these statistics, pretty badly. But if we can trade at or around break even for the most part, we're going to, partly by our skill, but also partly by dumb luck, we'll catch some big movers. And this is where the profit comes in over the series. We keep our losses real small. We'll have some small winners that cancel those out, and then we're going to be left with the big winners, the runners. Now, today's presentation, what I'm talking about here is this new Pivot High Swing Trading course. It's available to you today for $97. It's a complete, easy-to-implement swing trading system. It's got 2 built-in trading calculators, and I'm going to be doing a live training on February 11th on Saturday. That's going to be the first training of the year. So if you get in on this, you'll be just in time. You'll have plenty of time to go through all the materials and get used to how this all works, and then you'll be ready to come in for a 2-hour training. You can, to take advantage of this offer, we're going to put the link in the chat, but also you can send me a message to swingtradingclub@yahoo.com, and I will forward you the correct order form for this product. The swing trading course, you're going to learn 3 important factors: spotting a stock's technical trend shift, computing the entry points, and then where we put our stops, position sizes, price targets. Those are the 3 training lessons. So it ends up being a complete system. Again, just to review, you're going to learn the key moving averages that we want to watch for a crossover. You're going to learn how to mechanically draw this trend line. It's going to be perfect every time because there's rules to follow. It's real simple. It's not your standard trend line that you see in the textbooks. You know how to spot the pivot high now, and then you're going to have access to this calculator, which determines your buy points. The calculator also, I didn't zoom in on it, and I don't have time, it gives you your initial target, computes your average price, and it gives you a swing trading stop as well as an accumulation stop. All right? So I call this the new easy way to swing trade, because all your rules are in place, and all you do is follow the mechanical system. There's 3 videos, and what I did is, instead of having a training course and then like extra software, and I built it all in integrated. So you're going to install this Windows software on your computer. It's standalone. It's got 3 built-in training lessons, and then it's got the 2 built-in calculators. All right, again, today $97 gets you this software. we'll be posting a order form link, I think, in the chat. But if not, you can send me an email to swingtradingclub@yahoo.com, and I will forward you the correct order form to take advantage of this software. I can now take any questions if I have any time left. I see one question here. Does it work on Forex? This software pulls data off of Yahoo Finance. Now, in swing trading, we use end-of-day data, right? We're not doing intraday day trades on price wiggles intraday. So we basically utilize end-of-day data. That's free. The software automatically grabs it. You don't have to connect to anything. You just put your symbol in. It grabs the data. So to answer your question, if you have an ETF or some symbol that's related to Forex, then yes, you can utilize this. But intraday Forex trading using the Forex pairs, this is not what the software is for. Question, what moving averages are you using? Well, that's what you learn in the strategy. They're unique moving averages. Nobody uses these. There's nothing magical about moving averages, but these are the ones that, in all of my computer testing, these tested out the best for the swing trading time zone or time frame. Is the software for Windows machines only? Well, it's designed for Windows only, but if you've got a Mac and you can run Windows parallel, then this software will work fine. If you're not familiar with that, there's several pieces of software, some are free even, that allow you to run Windows software on your Mac machine. So if you've got an Apple, don't let that prevent you from utilizing this. We'll get you set up with one of these Windows emulator softwares. Like I said, they're free, and you'll be able to run this software then. I live in Brazil. Can I use your software? Yes. This software will work anywhere, and it will work on foreign stocks as well. Here's the thing. As long as you can go to Yahoo Finance, if you just go to yahoo.com and go to their finance, if you can type a symbol in there and get results, then it's going to work in the software. This particular strategy is only based on daily charts, and again, here's the big advantage of this strategy is this, that we are going to eliminate all of the minutia that we get bogged down in with technical analysis. Your MACDs and your RSIs and your stochastics have to do this, and you have to count X number of days and narrow range days and close above this level. We eliminate all of that, and the strategy again uses those three basic criteria. The trend line break, the moving average crossover, then the first pivot, and then we just go right to the calculator. So it's a no-brainer. An 8-year-old that can read directions could follow this system and make money in stocks. The software, the Pivot High Swing Trading course, is standalone, meaning whatever your trading platform is, the software is going to give you the strategy and the calculators to use, and then you can use it on the stocks of your choice in the trading platform of your choice. The technical criteria that you're going to work with is very straightforward and basic, so that means you're not going to have a charting platform where you can't find some specialized indicator. 2 basic moving averages, a mechanical approach to drawing a trend line, and then you're going to spot the pivots and use the calculators. Here's a good question. Can I automate the system for placing trades directly in my brokerage dealer? Well, for $97, no, you don't get that for 97 bucks. Actually, I'm glad you mentioned that. That's actually something I'm working on in the future, a completely automated system that will do this exact strategy. But here's the thing, don't get too lazy about wanting to automate everything. This is already pared down to like the most basic steps you can take. And so the great thing, and I didn't mention this, is just the time savings. You don't have to sit and sift through hundreds of stocks and look for all kinds of esoteric chart patterns, and which can be fun for a while when you're new to the markets. You're getting into all this cool technical analysis. But after a while, that gets to be a daily drag. So this strategy allows you to implement, a complete swing trading system in very little time. I mean, I don't want to say, oh, only 15 minutes a day or only 12 minutes a day, but very little time. All you got to do is look at the charts. Your moving averages are either lined up correctly or they're not. Yeah, it's a one-time charge for this software. Again, this is a complete course. There's 3 training lessons, and there's the 2 calculators which help you implement the strategy. It's all built into one, and it's a one-time payment. The question is, are the rules of the strategy? Yeah, here's the thing. I don't give away the formula for the pivot high calculator. That's too much of a proprietary formula, but you got the calculator to use. And then I teach you different ways to trail your stop. The software, the calculator automatically computes your initial stop losses for you. So again, it takes all the guesswork out. Question, which platforms do I use? Yeah, I'm a TradeStation guy. I also have accounts with other brokerage firms. I'm a day trader. I use a Ninja platform. Again, I'm going to be doing a training on February 11th. On a Saturday, so that'll give you time to get set up with the software, start reviewing the materials, start playing around with the calculators, and then when I do the training, you'll be able to ask questions live and get feedback. And also, I will be getting into a little bit more advanced type of concepts as well, based on this strategy. Okay, so if I think we're going to put a order link in the chat somewhere, or if not, send me an email to swingtradingclub@yahoo.com, and I will get right back to you with that order link that you want to use today to take advantage of this. That's my presentation. I don't see any other questions. I guess if you have any other questions, you can. I talk about how to find the stocks that you want to work with. Let me go back to the top. Will this work with options? Yeah, if you're an options trader, remember any kind of options trades, well, not any, but most of your options trades, you're going to be concerned with price movement anyways and setup. So yes, I always have a certain percentage of folks that use these strategies to trade options. Okay, that is my presentation. I don't see any new questions, so I am done. If you've got any other questions about this, again, you can email me at swingtradingclub@yahoo.com.